Today I'll be reading from Benjamin Graham's The Intelligent Investor. Basically, what we've been talking about lately on this book is that there's a difference between speculators and investors. Speculation is more exciting, more lucrative, more fun, whereas the intelligent investor's way is boring, more consistent, but profitable long term. So those principles apply throughout life. If it's boring and you're making slow, steady progress, it's probably for real. Oscar Wilde joked that a cynic knows the price of everything and the value of nothing. Under that definition, the stock market is always cynical, but by the late 1990s, it would have shocked Oscar himself. A single half-baked opinion on price could double a company's stock, even out of its value when entirely unexamined. In the late 1998, Henry Bludgett, an analyst at CBIC Oppenheimer, warned that, as with all internet stocks, a valuation is clearly more art than a science. Then citing only the possibility of future growth, he jacked up his price target on Amazon.com from $150 to $400 in one fell swoop. Amazon.com shot up 19% that day, and despite Bloget's protest that his price target was a one-year forecast, soared past $400 in just 3 weeks. A year later, PaineWebber analyst Walter Piecyk predicted that Qualcomm stock would hit $1,000 a share over the next 12 months. The stock, already up 1,842% that year, soared another 31% that day, hitting $659 a share. From formula to fiasco. But trading as if your underpants are on fire is not the only form of speculation. Throughout the past decade or so, one speculative formula after another was promoted, popularized, and then thrown aside. All of them shared a few traits. This is quick, this is easy, and it won't hurt a bit. And all of them violated at least one of Graham's distinctions between investing and speculating. Here are a few of the trendy formulas that fell flat. Cash in on the calendar. The January effect, the tendency of small stocks to produce big gains around the turn of the year, was widely promoted in the scholarly articles and popular books published in the 1980s. These studies showed that if you piled into small stocks in the second half of December and held them to January, you would beat the stock market by 5 to 10 percentage points. That amazed many experts. After all, if it were this easy, surely everyone would hear about it. Lots of people would do it, and the opportunity would wither away. What caused the January jolt? First of all, many investors sell their crummiest stocks late in the year to lock in losses that could cut into their tax bills. Second, professional money managers grow more cautious as the year draws to a close, seeking to preserve their outperformance or minimize their underperformance that makes them reluctant to buy or even hang on to a falling stock. And if a underperforming stock is so small and obscure, a money manager will be even less eager to show it in his year-end list of holdings. All of these factors turn small stocks into momentary bargains. When the tax-driven selling ceases in January, they typically bounce back, producing a robust and rapid gain. The January effect has not withered away, but has weakened. According to the finance professor William Schubert of the University of Rochester, if you had bought small stocks in late December and sold them in early January, you would have beaten the market by 8.5 percentage points from 1962 through 1979, by 4.4 points from 1980 through 1989, and by 5.8 points from 1990 through 2001. As more people learned about the January effect, more traders bought small stocks in December, making them less of a bargain and thus reducing their returns. Also, the January effect is the biggest among the smallest stocks, but according to the Plexus Group, the leading authority on brokerage expenses, the total cost of buying and selling such tiny stocks can rub up to 8% of your investment. Sadly, by the time you are done paying your broker, all of your gains on the January effect will melt away. Just do what works. In 1996, an obscure money manager named James O'Shaughnessy published a book called What Works on Wall Street. In it, he argued that investors can do much better than the market. O'Shaughnessy made a stunning claim. From 1954 through 1994, you could have turned $10,000 into $8 million, beating the market more than tenfold, towering 18.2 average annual return. How? By buying a basket of 50 stocks with the highest winning returns, 5 straight years of rising earnings, and then share prices less than 1.5 times their corporate rate revenues. If he were the Edison of Wall Street, O'Shaughnessy obtained U.S. patent something or other for his automated strategies and launched a group of 4 mutual funds based on his findings. By late 1999, the funds had sucked in more than $1.5 million from the public, and his annual letter to shareholders, O'Shaughnessy stated grandly, "As always, I hope that together we can reach our long-term goals by staying the course and sticking with our time-tested investing strategies." But what works on Wall Street stopped working right after O'Shaughnessy published it. Figure 1.2 of his fonts sank so badly that they shut down in early 2000, and the overall stock market, as measured by the S&P 500 index, walloped every O'Shaughnessy fund almost nonstop for 4 years running. In June 2000, O'Shaughnessy moved closer to his own long-term goals by turning the funds over to a new manager, leaving his customers to fend for themselves with these time-tested investment strategies. O'Shaughnessy's shareholders might have been less upset if he had given his book a more precise title. For instance, "What Used to Work on Wall Street Until I Wrote This Book." Ouch.